The next learning objective is to account for the sale of inventory using a perpetual system. So when we sell inventory, we're going to have to do two journal entries. The first one will be using the sale price, the amount we're charging the customer, and then the second journal entry will be showing the cost of the inventory, cost to us. So let's talk about sales revenue. Remember, sales revenue, also called sales, is a revenue account, and it's the amount that we are earning from selling the inventory. So when we record this selling of inventory, we're going to get one of two things when we make a sale. We're either going to get cash, or if we're going to sell it on account, we're going to get accounts receivable. So the debit's either going to be AR or cash. And then we have to record the revenue. Remember, sales revenue is a revenue account, hence the R in parentheses, and it's going up. So we are recording a sale on account. If it's a cash sale, we'd be using cash instead of accounts receivable. Okay, so remember, when we do the sales transaction, when we sell inventory, the first one is going to be at the price that we are charging the customer. So price means the amount we are charging the customer. Cost means how much the item costs to us. So we're going to record the cost in the second journal entry. So the second journal entry, we're going to lower inventory and we're going to increase cost of goods sold. Remember, this is an expense account. Cost of goods sold is just another way of saying, what was the cost of the inventory that we just sold to the customer? So remember, cost of goods sold, COGS, C-O-G-S, is an expense account. So we have to increase that expense account, and then we have to lower inventory. So what we're doing in the second transaction when we sell merchandise is we're transferring the cost of the inventory from an asset, which is called inventory. We're transferring it to cost of goods sold, which is an expense. So inventory on our balance sheet is being lowered, and then on our income statement, this expense called COGS, cost of goods sold, is increasing. So remember, the first of the two transactions is the amount the seller receives for the merchandise from the customer. And the second transaction is the amount the seller paid. In other words, it's the cost of the merchandise to the seller. So now let's look more closely at the sale of inventory and the revenue account. So what's the normal balance of sales revenue? Well, since it's a revenue account, as all revenues do, its plus side is on the right. It's a credit balance. Now let's talk about the sales returns and allowance account. So as a seller, we want to keep track of sales returns and sales allowance in case some customers are taking advantage of our sales return. Our sales return policy could be too easy and maybe 80% of our sales are being returned. So that's one of the reasons why we want to keep track separately of our sales returns. So this sales returns allowance account is actually going to offset our sales. So when a customer returns goods or the seller gives a reduction in price to the customer, this is called a sales return or a sales allowance. So this sales returns allowance account, since it offsets sales revenue, it is a contra revenue. Contra meaning opposite. So its positive or plus side will be the opposite of the revenue account. So notice sales returns allowance has the plus sign on the left side. So it normally has a debit balance. And then sales discounts, what this is if a customer pays within the discount period and we give them a discount on the price, this is called a sales discount. It too is a contra revenue. So it offsets our sales, or in other words, it lowers our sales. So we've learned two new types of accounts: sales returns allowance, a contra revenue, and sales discount, which is also a contra revenue. So now here's where some students get tripped up. A sales discount occurs when we are making the sale and we give the discount. Remember, the purchase discount was when we purchased something and we got the discount. So you need to be able to distinguish between a sales discount and a purchase discount. So in a perpetual inventory system, if we are constantly updating our inventory every time we buy or sell, how are we doing that? If you work for Target and every time someone comes and gets a bag of groceries, does that mean the accountant has to peek inside the bag of groceries and go run to the accounting system and lower inventory and increase sales revenue and record cash or AR and then cost of goods sold? No, it's too much work to do. So the only way we're able to do this is if the grocery seller, like Target, uses barcodes. So when the cashier scans the barcode, the computer system is automatically going to record the sale, and it's going to say if we have cash from the customer or if we're going to sell it on account with a debit card or a credit card. And then it's going to record cost of goods sold and then lower inventory in the second transaction. This is called a point of sale system, and it updates your inventory automatically. So it updates the cost of inventory and it updates the count of inventory. And the system, if it's robust enough, it could even automatically do purchase orders automatically. If you get to like 5 widgets left on the shelf, it can automatically order more widgets. So now let's look at recording a sales return or a sales allowance. So when we record a sales return, what we need to do is we need to increase our sales returns and allowance account. And remember, it increases on the debit side. And assuming that the customer, purchased this from us on account, we need to lower our AR. And in the second transaction, and remember this $100, we're assuming this is what we charge the customer for the item. And then we need to increase our inventory since the inventory is being sent back to us. And then we need to reduce our cost of goods sold. So again, this is a sales return, which means we have sold something to the customer and the customer is now returning it back to us. Now, if you look carefully at this transaction, it's really pretty much the reverse of the sale, with the only difference being instead of reversing the sales revenue account, we're using sales returns and allowance. And then the comment for the transaction would be customer return merchandise. Now, if we're going to give them an allowance instead of them returning it, then the second transaction where we're increasing our inventory because we have to put the item back on the shelf, this would not exist if we're just giving them an allowance. In the case of giving them an allowance, we would increase the sales returns and allowance account, and then we would reduce their AR, showing them that they owe us $100 less. Okay, now we're going to learn how to account for a sales discount. So let's assume the original sale was we increased AR with a debit, $100, and we increased sales revenue, $100 credit. And then cost of goods sold was increased with a $60 debit, and inventory was lowered for a $60 credit. So what this is saying is we sold inventory that cost us $60, and we sold it for $100, but it was sold on account for AR instead of cash. Now, the customer is going to pay us within the discount period, and the original terms were $210 net 30. What this means is that if the customer pays us within 10 days of the purchase, they get 2% off. Otherwise, the net amount is due within 30 days. So if the item costs us if the item costs the customer $100 and we increase their AR, but when they pay us off, they're getting a 2% discount. How much are they actually paying? Well, they're paying $100 minus a 2% discount. 2% of $100 is $2. So they're paying $100 minus 2. So cash for us, the seller, is increasing by $98. The discount amount is going to go into the sales discount account. So that 2% discount, which is represented by these $2, goes in the sales discount account. Now remember, the sales discount is a contra revenue, so it has a normal balance, a debit balance on the left side. So that's why we're putting it on the left side. And now that they paid off the AR, we have to remove the whole AR. So that will be a credit for $100. So remember, only use the sales discount account when we made the sale and the customer pays early and gets the sales discount. So let's look at the part that confuses students the most in this chapter, paying early, sales discounts versus lowering the inventory cost. So when would we use a sales discount? Sales discount, which we just showed on the previous slide, is used when we make the sale and the customer pays early. So the discount amount that they are saving will go into the sales discount account, which is a contra revenue. Now, if we paid early and we get the discount, that discount just simply lowers the cost of inventory. A lot of students will mistakenly try to use a purchase discount account, but we don't do that in the perpetual inventory system. So don't forget the difference. Sales discount is when we made the sale, customer gets the discount. And if we pay early and we get the discount, we just have to simply lower the cost of inventory. Now let's look at how we calculate net sales. So net sales is simply you take all your sales. Remember, this is also known as sales revenue. You subtract your sales returns and allowance, and you subtract your sales discounts. So we're subtracting these two contra revenue accounts. So we have our revenue account minus the two contra revenue accounts gives us net sales. So which one of these numbers do you think investors and banks that are thinking about giving this company a loan are more interested in? Are they more interested in this raw sales number or the net sales? Well, they're more interested in the net sales number. In fact, when a company publishes their income statement, they usually start with net sales, and then the information for gross sales and returns, allowances, and sales discounts are usually in the footnotes. So once we've calculated the net sales, then we can subtract our main expense, cost of goods sold, and that gives us our gross profit. So this gross profit number is something that merchandisers find to be very important. And people who are thinking about investing in these merchandisers look at the gross profit. It's a very significant number. And remember, on the income statement would be net sales minus cost of goods sold equals gross profit. And then the company's other expenses would be listed after this.